Are you sitting in seat 23 when you wonder how a single number, something as simple as an interest rate, can have such a profound impact on the whole economy? You're curious about what happens when it changes. How does that ripple through everything from your grocery bill to the price of houses and even stocks? Let's dive in. Imagine you have $100 in your piggy bank. Now, let's say your parents promise to give you 5% interest each year if you keep it there. That means by next year, you'll have $105. This is a simple example of an interest rate, how much extra money you earn on something that's saved or borrowed. Now, think about the economy as a giant piggy bank for everyone. When banks raise their interest rates, they're essentially saying, hey, if you want to borrow money, it costs more. This makes borrowing less attractive, which means people and businesses are likely to save more rather than spend and invest. And here's the surprising part. When spending slows down, everything starts to slow down too. Less spending means fewer goods are bought and sold, fewer jobs might be created, and overall economic growth can stall. It's like if everyone in a busy mall decided not to buy anything. Retail sales would drop, and stores might have to lay off some workers. So, just by changing this one number, the economy starts to react in big ways. But how exactly does that work? And what happens when interest rates go down instead of up? We'll explore all of this together, making sure you feel like you've unlocked the secret behind these numbers. You're sitting in seat 23A. Try and make sense of all the financial news that's swirling around you. Today, it's about interest rates and how they move the whole economy. You've heard terms like key rate hikes or emergency rate cuts, but what exactly do these mean? Let's dive in. Imagine the economy is a car, and interest rates are the gas pedal. When a central bank, let's call them the bank of your country, raises interest rates, it's like stepping on the brakes. Lenders suddenly want higher returns for their money, making borrowing more expensive. This could deter businesses from expanding or taking out loans to invest in new machinery or hire more workers. Similarly, higher mortgage rates might make buying a house less attractive to you. And here's the surprising part. It's not just about the rate itself, but how changes in the rate signal the economy's health. When interest rates are raised, it can indicate that inflation is becoming a concern. The central bank wants to cool down an overheating economy by making borrowing harder and more expensive for everyone. Let's break this down further. When you take out a mortgage, you're essentially borrowing money from banks. If the bank of your country raises interest rates, the cost of that loan goes up. For example, if your initial rate was 3%, it might increase to 4% or even higher. This means more of your monthly payment is going towards paying off the interest, leaving less for the actual principal. Now, think about a business owner who needs a loan to expand their operations. If they can only afford lower interest loans because rates are high, they might hold back on expansion plans. They'd rather wait until borrowing costs come down, ensuring they can pay those loan repayments without squeezing profits too much. This hesitation means fewer jobs created or projects launched. It's like when you're driving and see a red light. You slow down, prepare for potential stops, and adjust your overall journey. Similarly, higher interest rates make the economy slow down because businesses and individuals have to be more cautious with their spending. Interest rate changes are like the bank of your country sending out a message. Hey, we think economic activity is growing too fast, so we're making it costlier for everyone to borrow. This gives everyone time to adjust their plans, just as you might slow down before an intersection. You're sitting in your cozy living room, looking at a stack of bills and thinking about those pesky mortgage payments. Suddenly, you hear the news. The central bank has just lowered interest rates. Now, here's what's happening under that headline. First, let's break down what interest rate means. It's essentially the price of borrowing money. When it drops, it becomes cheaper for everyone to borrow. And when something gets cheaper, more people and businesses are inclined to take advantage of it. Imagine you want to buy a new car. The current interest rates are like the cost of renting a seat in an airplane. Lower rates mean cheaper tickets. So now, instead of worrying about saving up enough cash for that down payment or monthly payments, you might decide to go ahead and sign that loan. After all, it's getting cheaper to fly than you thought. And it's not just cars. This effect trickles down to businesses too. A local coffee shop owner needs a loan to buy new equipment and expand their business. With interest rates lower, they can afford the loan more easily, which means they might take that jump and hire another barista or invest in better machines. That's how lower interest rates encourage borrowing and spending. It's like giving everyone a little extra money in their pockets, albeit borrowed, to spend on things like homes, cars, and businesses. And when people start using this borrowed money to make more purchases or invest, it kicks off a chain reaction. Suppliers see increased orders, they can hire more workers, and thus the economy starts to stir. But what happens when interest rates go up? The cost of borrowing increases, making those airplane tickets more expensive. Suddenly, that car seems less affordable, and businesses might hold back on expansions because the cost of financing their growth has become too high. In both cases, it's all about how these changes in borrowing costs ripple through the economy. Lower interest rates encourage spending because people feel they can afford more debt. Higher interest rates do the opposite. They make borrowing more cautious and potentially slow down economic activity. So next time you hear about a change in interest rates, remember, it's not just a number. It's a signal that can either push the whole economy forward or slow its pace. You're sitting at your desk in front of a screen filled with graphs and charts, trying to make sense of all these numbers swaying back and forth. You notice that interest rates have been moving, and you wonder how they might be affecting the bigger picture, specifically investments and savings. And here's the surprising part. When interest rates rise, it means saving money in a bank is more appealing. Let's use an analogy to understand this better. Imagine you have some spare cash in your piggy bank. When interest rates are high, it's like finding out that your piggy bank gives you more candy for every dollar you put in each day. You might start feeling less inclined to spend the money on a new toy and instead keep it safe in your piggy bank. Conversely, when interest rates are low, saving doesn't seem as attractive. It's like your piggy bank only gives out one piece of candy per dollar. So, you're more likely to take that cash and buy that toy, or maybe even invest it elsewhere, like in the stock market. Now, let's see how this affects investments. When interest rates are high, people tend to save more because they get better returns from savings accounts compared to the risky and volatile world of stocks. This means there's less money flowing into the stock market, which can cause prices to drop. Here's a concrete example. Imagine you're considering whether to buy shares in a tech company or put your money in a high-interest savings account. If interest rates are high, you might decide that keeping your cash safe with higher guaranteed returns is better than risking it on volatile stocks. This shift in behavior can lead to lower demand for stocks and potentially a downer in the stock market. But when interest rates are low, the opposite happens. People start seeing savings accounts as less attractive compared to investing, just like if your piggy bank only gave out one piece of candy per dollar. This means more people might choose to invest their money in stocks or other assets, driving up demand and potentially pushing stock prices higher. And here's a key point. When overall investment shifts towards stocks, the broader economy benefits from increased spending on new technology, innovation, and expansion. But if everyone is saving instead, it can slow down economic growth because there's less money being spent on businesses that are already running smoothly. So, you see how interest rates play a crucial role in steering where people choose to put their money. They influence not just your personal financial decisions, but also the big picture of the economy as a whole. Now that we've looked at how interest rates affect your investments and savings, let's zoom out a bit and see the bigger picture. Imagine you're flying through the clouds in an airplane, enjoying the smooth ride of steady economic growth. But beneath those clouds, there's turbulence called inflation, and sometimes the economy needs to be slowed down or sped up. Central banks, like pilots of this economic plane, use interest rates as their primary tool to navigate. When they see signs that the economy is growing too fast, like planes filling up the sky too quickly, they raise interest rates. This means it becomes more expensive for businesses and individuals to borrow money, slowing down spending and cooling off inflation. And when the opposite happens, when the economic plane is underflown with too few passengers, the central banks lower interest rates to make borrowing cheaper. This encourages people and companies to spend and invest more, helping to lift the economy back up. So, here's a surprising part. These interest rate changes aren't just about your savings or investments. They're like the rudder of an aircraft, steering the entire plane. When central banks raise rates, they might be trying to cool down an overheated economy and manage inflation, preventing the plane from crashing into the ground. Lowering rates is their way of ensuring there are enough passengers in the air, keeping the economy stable and growing. That's why you'll often hear that interest rate decisions by central banks are closely watched. They can mean big changes for businesses, jobs, and even your own finances. They're not just about numbers. They're like the invisible hands steering the ship of our economy to ensure it sails smoothly through all sorts of weather conditions. All right, so let's wrap this up. You're now sitting back in your seat with a newfound understanding of how interest rates move the whole economy. You've seen that when the central bank raises or lowers interest rates, it's like adjusting the volume on a very loud radio station. The signal is clear. Borrowing becomes more expensive and savings earn higher returns.